Hello, everybody, and welcome back to another workshop presented to you by the Taxpayers Help Center and LITC. Today, we are going to be discussing and going over debt relief, demystified, understanding the tax impact of canceled debts, foreclosures, and more. So I will say that this presentation is being recorded. So if you don't want to be in the recording, go ahead and keep your cameras off and make sure your mics are muted. And then for anyone that does join late, we will be answering questions at the end of the presentation. So who we are. We, once again, are the Taxpayers Help Center, which is a nonprofit organization located here in Northridge, California. And we operate two tax clinics. So the first one is our low income taxpayer clinic, which is the LITC. And here is where we help taxpayers resolve their tax disputes with the IRS, also known as the Internal Revenue Service. And then our second clinic is a volunteer income tax assistance, also known as VITA clinic. And here is where we help prepare income taxes for free. Sue Shatoni, he is a CPA. He is going to be the director for both clinics, the LITC and the VITA. And then my name is Amiel Duncan, and I am the director of outreach for the LITC. Now, how to support. So individuals and businesses can support us financially by donating funds to help us expand and the reach of our services. They can also volunteer their time or expertise in order to help us spread awareness about our services. And then lastly, we help taxpayers locally and beyond, so not just in Los Angeles County. We are an IRS authorized certifying acceptance agent, also known as a CAA, for the individual taxpayer identification numbers, also known as ITINs. So for applications for ITIN numbers, you can go ahead and call us today to set up an appointment, or you can also shoot us an email. Our email is going to be info@taxpayershelpcenter.com. Once again, we're going to be located at 9029 Reseda Boulevard, Suite 209 in Northridge, California, 91324. Our phone number is going to be 818-366-0111. Our website is www.taxpayershelpcenter.com. And lastly, if you feel that today's workshop was beneficial for you and can be helpful to someone you know or love, you can go ahead and send them to our Facebook page, which is Taxpayers Help Center, Inc., a nonprofit tax organization, where this presentation will be uploaded later today. And then we also have past presentations and past workshops that we have hosted on our Facebook. And lastly, with our Facebook, if you do stay connected with us through our Facebook, you will be notified of upcoming events. So with that being said, let's go ahead and jump right in. So first, we're going to discuss the overview of canceled debts and taxability. So when lenders forgive part or all of debt, the forgiven amount is considered taxable income by the IRS. And then canceled debts can arise from credit cards, personal loans, student loans, or mortgages. And without proper documentation, you might face unexpected taxes. So typically we see three common scenarios for this. So the first one's going to be credit card debt. So if settled or forgiven, the IRS considers the unpaid amount as income. For foreclosure, if a home is foreclosed and the forgiven loan balance is more than the home's value, the difference may be taxable. And then lastly, with repossessions, if a car is repossessed, any remaining loan balance after the sale could be treated as taxable income. So in each case, the IRS may require tax on the forgiven debt unless specific exclusions do apply. Now, the purpose of Form 1099-C. So this form is issued by lenders when they forgive $600 or more of debt, notifying both you and the IRS about the canceled amount. Even if you don't receive Form 1099-C, you're still responsible for reporting forgiven debt as taxable income. And then for tax relief options, such as bankruptcy, insolvency, and more, certain laws do allow you to exclude canceled debts from taxable income under specific situations, such as insolvency, which is where your debts exceed your assets, or bankruptcy. Go ahead and move yourself. Now, what is canceled debt? So canceled debt is generally taxable income. So if you owe $10,000 and settle by paying $5,000, the IRS considers the remaining $5,000 forgiven as taxable income. This is called cancellation of debt, also known as COD income. And this must be reported on your tax return unless it qualifies for an exclusion. Now, also with canceled debt, it's an introduction to Form 1099-C and its significance. So lenders issue Form 1099-C to report any amount of debt that's been forgiven. If you're required to include this form's information on your tax return, even if you don't receive it directly in the mail. So it's important to note that even if you don't receive this form from the IRS, it is still your responsibility to fill out this form and attach it to your tax return. If not, there are consequences that can come with that. And then lastly, when debt cancellation is not taxable, exclusions for insolvency or bankruptcy. If you were insolvent, debts exceed your assets. At the time of debt cancellation, you may be able to exclude the forgiven amount from taxable income. Canceled debts due to bankruptcy are also not taxable, so you'll need to file Form 982 to claim these exclusions. Now we're going to go ahead and move on to foreclosures and repossessions, tax implications. How foreclosure or repossession is treated like a sale. So when a property is foreclosed or repossessed, the IRS treats it like a sale. This means you need to report any financial gain or losses on your taxes. The key factors in determining this are the outstanding loan balance, so what you owe, and the fair market value, also known as FMV, of the property, so what it's worth. If the FMV is less than the loan balance, you may have a taxable cancellation of debt, also known as COD income. Now for taxable gain or loss calculation, when a property is foreclosed, the IRS treats it as if you sold the property. So to determine if there is taxable gain or loss, you compare the property's fair market value, FMV, to the outstanding loan balance. For example, if your foreclosed home is valued at $200,000, but you owe $250,000, the difference of $50,000 is considered cancellation of debt income, which may be taxable. This calculation helps assess your financial liability after the foreclosure. The impact of recourse versus non-recourse loans. So what is a recourse loan? If you have a recourse loan, you are personally responsible for the debt. This means that if the property is foreclosed, any amount forgiven beyond its fair market value, FMV, is considered taxable income. Now, for non-recourse loans, with the non-recourse loans, the lender can only take the property and cannot pursue you for any remaining balance. This limits your taxable cancellation of debt, COD income, as you are not personally liable for the shortfall. Then we have possible exclusion under the Mortgage Debt Relief Act. So this allows you to exclude forgiven debt on your principal residence from taxable income under specific conditions. This relief is applicable only for the cancellations that occur before 2026. So it provides financial relief by preventing the IRS from taxing you on certain forgiven amounts related to your home mortgage, helping homeowners who might otherwise face a tax burden due to debt forgiveness. Now, moving on to the next portion of this workshop, we're going to be talking about insolvency and bankruptcy, avoiding tax on canceled debt. So the definition of insolvency and how to calculate it. Insolvency occurs when your total debts are greater than the total value of your assets. So to determine if you are insolvent, you can use an insolvency worksheet, where this worksheet will help you assess your financial situation by listing all of your debts and assets, allowing you to see if you qualify for certain tax exclusions related to canceled debt. Bankruptcy and its impact on canceled debt. So when debts are discharged through Chapter 7 or 13 bankruptcy, you are not required to pay taxes on the amounts that have been forgiven. This means that the forgiven debt will not count as taxable income, and to officially report this exclusion, you must use Form 982, which I have listed, posted for you to the side. This form allows you to inform the IRS about the forgiven debt and claim the tax relief provided by the bankruptcy discharge. Now, how to use Form 982 for exclusions. Form 982 is used to inform the IRS that your canceled debt qualifies for exclusion under bankruptcy or insolvency rules. So So by completing this form, you document that the forgiven debt should not be counted as taxable income, ensuring you don't face a tax burden on these amounts. It is an essential step for claiming tax relief after debt cancellation due to financial hardship. Now, I know it's a little hard to read, but this is basically what the form kind of sums up as and looks like. So in further detail how to use Forms 982, you're going to want to follow these steps. So first, you're going to download the form. If you did not receive it in mail by the IRS, you're going to want to download the form. So obtain the form from the IRS website, Form 982. Second, you're going to fill out all of your personal information, such as your name, social security number, and other identifying details. Third, you will indicate exclusions. So you're going to specify whether the canceled debt is due to bankruptcy or insolvency in the relevant sections. And then lastly, number 4, you're going to attach this to your tax return. So make sure that it's included or that you include the completed form with your tax return for the year the debt was canceled. Now, lastly, you want to make sure to keep copies of your records for detailed instructions. You can always go ahead and check out the IRS website. Now, abandonments. What happens to your taxes? So abandonment versus repossession, key differences. So abandonment refers to the voluntary decision to give up property without transferring ownership to another party. This means you simply leave the property behind. And then repossession, on the other hand, occurs when a lender or creditor takes back property due to non-payment or default on a loan. So in this case, ownership is reclaimed because of the borrower's failure to meet payment obligations. Now, to report abandoned property on tax returns, when you do abandon property, any losses incurred must be reported on your tax return. These losses can be classified as either capital losses or ordinary losses, depending on the type of asset involved. Capital losses are typically associated with investments or personal property, while ordinary losses apply to businesses or apply to business assets or inventory. Correctly categorizing these losses is essential for accurately calculating your tax liability and any potential deductions. Now, practical advice / tips to minimize tax impact. So you can always explore loan modifications or repayment plans. So loan modifications can adjust the term of your existing loan, potentially lowering your loan balance, interest rate, or monthly payments. This process usually doesn't trigger cancellation of debt income, which means you won't have to report the reduced amount as taxable income. Additionally, many lenders offer workout programs designed to help borrowers avoid foreclosure or repossession. These programs can often provide flexible repayment plans, allowing you to catch up on missed payments while keeping your property. Engaging with your lender early can lead to better outcomes and reduce financial stress. Now, understand your options with the IRS Taxpayer Advocate. So, the Taxpayer Advocate Service, also known as TAS, TAS, offers free assistance to taxpayers facing complex debt situations. TAS helps individuals navigate issues with the IRS, especially those that are difficult to resolve or where taxpayers are experiencing financial hardship. They provide guidance, advocate on behalf of taxpayers, and can help identify available relief options. Engaging with TAS can provide crucial support when dealing with complicated tax matters or disputes with the IRS. Now, to basically wrap up today's workshop, in conclusion, when a lender forgives a debt, the IRS generally considers it taxable income unless specific inclusions apply. This means that you may need to report it on your tax return. Foreclosures and repossessions, these situations are treated similarly to selling an asset, potentially leading to tax consequences if the forgiven amount exceeds the property's fair market value. And then lastly, with bankruptcy or insolvency, if you file for bankruptcy or can demonstrate insolvency, which is where your debts exceed your assets, you may be able to exclude canceled debts from your taxable income. And with that, that wraps up our workshop for today on debts. Thank you all for your patience and your time today. Once again, oops. Once again, you go ahead and stay connected with us. We're located here in Northridge, California. Phone number is 818-366-0111. Check out our website at www.taxpayershelpcenter.com. Shoot us an email at info@taxpayershelpcenter.com if you have any questions or if you need assistance with anything tax related. And then lastly, if you want to go ahead and get a refresher on today's workshop or send it to a loved one, go ahead and check out our Facebook, which is Taxpayers Help Center, Inc., a nonprofit tax organization. And with that, I'm Amiel Duncan once again. Thank you all. Bye.